Hi, okay, everybody. I think in the interest of time, it looks like we're still waiting for a few more, but I think we'll get underway just so that we are make a prompt start. So, um, good morning and welcome back to the K3 Hub. After our short break over the summer, I hope you've all had a good summer and you're back revived from summer holidays and so on, with children having been dispatched back to school. So, as I say, good morning and welcome back to the K3 Hub. For those who haven't virtually met me before, my name is Marie Wadeson, and I'm a managing director at Quantuma. And on behalf of our parent company, the K3 Capital Group, I am also responsible for K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. Since we launched the K3 Hub in the spring of 2021, over 2,750 like-minded professionals across the country even, have joined the network, through which they've accessed a range of CPD and training sessions not dissimilar to today's event. They've also benefited from referral fees for certain types of work which have been referred into our group, which is great. Today we've got a 3-hour CPD session on commercial property taxes. Before I introduce you to Ros, our speaker, I've got a few pieces of housekeeping that I'd just like to run through quickly. So I'm often asked this, so just to confirm, we are recording today's session and the webinar will be on the K3 Hub website next week. Q&A function is open, so please do feel free to ask questions as we go along. Our preference is that we do use the Q&A function rather than the chat, so that Ros knows where to find all of the questions rather than looking in two different places, because the chat is on, so you can chat with the team are running this in the background as well as the speaker. But if you could just use the Q&A for your questions, that would be great. We are going to post the slides presentation into the chat. Team may have done that in the background already, and we'll do that periodically through the session for those people who may join a little later on. We know it's been hot this week, and we also know that this session is 3 hours long, so we are planning a few comfort breaks. They will generally take place on or sort of around the hour. And finally, we do have some poll questions, which we'll be running periodically through the session. We'd be very grateful for your participation in those. Okay, so on to today's session then in that case. So I am very pleased to be able to welcome back Ros Martin, who has spoken for us on a number of occasions at the K3 Hub and has always proved very popular. Ros is a consultant and a lecturer and covers all aspects of direct tax as well as stamp duty, land tax. Today's session will broadly cover ownership structures and trade-in versus investment, capital gains tax, including calculation of gain and issues for non-resident property owners, capital allowances, including structures and building allowances, leases, and then finally stamp duty issues for commercial property. For those who regularly join our sessions, as I've already said, you might recall that Ros ran our commercial property tax update last year and a session on entrepreneurial themes earlier this year. Ros sessions really are extremely popular, so we've got high expectations today, Ros, and they do attract, generally speaking, the highest number of registrants for our CPD sessions. Indeed, I think today Ros may have broken her own record for the number of people we've got planned on attending. So no pressure whatsoever on you,
No
Ros, today. So all that remains for me to say is thank you very much for joining us. Hope you enjoyed today's session. We're always keen to hear your feedback at the K3 Hub. So I think we'll be putting up some contact details later on. You can find me on LinkedIn. So I would love to hear from some of you if you've got ideas for the types of subject matters that you might want to hear through the K3 Hub. We are all ears. I think just a quick note on our next session. So we've got an employment law update on Friday, the 6th of October. Watch out in the next few days for your invites, which will land in your inboxes. And that's all I've got to say. So Ros, right over to you.
Thank you very much. Yes, and just to reiterate, please do feel free to ask as many questions as you want to in the Q&A box. I will deal with them as I go along if I can. So Marie's outlined what we're going to talk about today, and we're going to start off this morning by looking at ownership structures. Ownership of property generally is subject to a great amount of debate. There's a lot of property websites out there telling people how much money they can make out of investing in property, although typically that tends to be targeted at residential property really rather than commercial. And often people are pushed towards holding property in a corporate structure. But when we're talking about commercial property as opposed to residential property, I think that the reason for holding the property is much more important when we're determining the structure, because some people do invest in commercial property. Some people do see, a property and think, actually, that's a good investment. Although traditionally in the UK, the value of commercial property has not gone up as much as residential property. So if you're doing it purely for capital value, it may well be that actually commercial property is not the way that you would go. What is more often the case is that people have either owned a property currently in relation to a business, or that they own a property because it used to previously be the business premises, and effectively they have carried on owning it to get an income stream from it. Or it may well be, as I say, that it's an ongoing business. Or it might be that you have a property which is currently associated with a business, and you're keeping or you're holding it in a particular way because of a longer term strategy. So it might be that you've got a business, very successful business, you own the business premises, but you're thinking, do you know what, I'm going to sell that business in the future, but I'm going to keep the property as a pension fund. So if you're holding property as an investment, you have got exactly the same options for holding that property as for a residential property. You can have it as an unincorporated business, as a partnership, as a company. There is less distinction between holding property personally and in a corporate structure where you have commercial property, because you don't have the interest restriction. With residential property, you don't get, if you are holding it as an individual, you don't get a full deduction for your interest, which is why people are so keen to get property portfolios into companies. That is not the same with commercial property. Now, one of the things that is motivating people in relation to property, however, would be that from 2026, when we go into Making Tax Digital, then you will have to comply with MTD and all of the horrible things that are going to be associated with that. And obviously, that is going to motivate some people to think about it. All of your property, whether it is commercial or residential, is going to be a single business if you are holding it in the same capacity, which means that if you do have borrowings, for example, that can cause some complications. And I think I gave this example last time, but I have got a landed estate. Sorry, MTD, Making Tax Digital. I apologise. I shouldn't use jargon. I do normally try and explain it, but MTD, Making Tax Digital, which is going to come in from 2026. So the example I gave last time was that I have a landed estate as a client. So we have the main house, which is used for some bed and breakfasts associated with a weddings business. We have some long-term residential lets. We have farmland, and basically we have a rental portfolio which covers some commercial, some domestic, and that is effectively a sole trader. And we have huge difficulties sorting out the borrowings, what money is being borrowed, where there is interest restriction, and so on. So there can be some complications. Loss offset against the property income from the same business, but not sideways loss relief. Although saying there's not sideways loss relief, if you have got losses generated by capital allowances, you can set them off sideways against your other income. And obviously, with commercial property, as we will see a little bit later on, you can claim capital allowances. And so there is more of a possibility that you would be able to offset losses. Obviously, if you're using a company, then you have exactly the same questions as you would do with any incorporated versus not unincorporated business. What's the tax burden and so on. Losses can potentially be used more flexibly, but if it's just property, that's not going to help you. If you're holding your property as part of the business, so as the slide says, we're thinking about a situation where you've got maybe trading premises. If it's a sole trader, then the property is automatically going to be an asset of the business. If it's a partnership, you can either be holding it outside of the partnership or in the partnership as a general partnership asset, or in the partnership but with a capital asset retained by one or more of the partners. To be honest with you, if you've got a partnership, the biggest issue that we often have is actually working out who owns the property, what the capital assets are, what the general, whether it is held generally by the partners. Is there actually any argument that it's held outside of the partners? Particularly when we're talking about family partnerships, there's often a significant lack of information about the structure. If you're trading through a company, obviously, again, the property can be inside the company as a business asset, or it can be held outside. Now, the way that you hold it will often depend on what your future plans are. Sometimes people will want to have their pension fund hold the property, because any future growth in value is going to be exempt from tax. You can then generate income for your own retirement going forward. I was having a conversation with someone last week, and they were saying actually SIPs are finding it very difficult to borrow money to buy commercial property, because banks don't particularly see that commercial property is a good investment currently. And actually that might be something that you need to think about in general terms. What is difficult is actually if you have a company that already has a property, is getting that property into your pension fund. It's very difficult to make an in specie contribution of the property. So what you might be thinking about is there any reason to separate the trade in the property? Do you want to separate the property because there might be liability issues? So is there anything intrinsically risky about your business that might mean that the property would be vulnerable? Though that can, if you've got, say, a company, be achieved by having a company separated into a new property company within the group. As I've said already, with properties, there may well be the thought that you are going to retain that property following the sale of the business itself. And again, that's something that you might want to look at. Obviously, if you are holding property outside of a business, either outside of a company or outside of a partnership, then you are only going to get, say, 50% BPR. So again, there are some planning issues there in relation to IHT. If you are holding property outside of a business, are there issues with charging rent? If you are a partnership and you are paying rent to one of the partners, you need to remember that any rent paid is actually part of the profit share. So, for example, there would be a national insurance contribution liability on the rental. If you have a company and rent is being paid, obviously that will be taxed on the owner. There is no NIC difference. Obviously, there are other issues. To be honest with you, one of the biggest problems that I ever have, I ever see, or I do see, when you're talking about property held differently from the actual business, is what happens when you incur costs on the business. So to give you incur costs on the property. So to give you an example, I have a situation, again, it's another farming client, where they have got the property being held outside of a company, but the farming business being held within a company or being run through a company. And that was actually, this was something that was done for BADR planning exercise. And what we've got, and then the next point in the slide talks about this, is that we have got improvement costs on the property have been incurred by the company. And effectively, that company, the property is now being sold. And we've got to consider, well, the company wants to be compensated for the improvement costs. What are the tax implications? Can we actually have a situation where the individual now effectively compensates the company? Will they then be able to deduct that against the capital gains on any subsequent sale? The problem that we've got in very general terms is that the purchaser in this particular situation is being a little bit awkward, which is making planning in relation to the who's going to get payments quite difficult. So the purchaser is basically saying, well, I want to buy this property off the individual. I'm not going to make any payments to the company in compensation for the improvements, and so it's about managing that process. And as I've said, holding via a SIP is not necessarily very straightforward currently. And even though I have talked about it in the past, I think that following on from this conversation last week, some SIP providers are really pushing back on holding business property, particularly where you have got issues with perhaps the business using the property. So it's not necessarily very straightforward. Okay, so someone's asked, what are the tax implications for overseas companies? I'm going to be talking about CGT for overseas companies a little bit later on, but in terms of having your property held in an offshore company, any income generated by that company is going to be subject to tax in the UK, because UK property income is going to be taxable within the UK, regardless of the residency of the company. So to a certain extent, if you have an overseas company owning property in the UK, whether that is used for rental purposes, or perhaps it is used by an affiliated business, then that overseas company is going to be a non-resident landlord. They should be registering as a non-resident landlord, because the issue with non-resident landlords is that rent should be paid under deduction of tax. And so that's exactly the same for commercial property as it would be for residential property. So if you don't want to have your income under deduction of tax, then you can elect, or you can register with HMRC as a non-resident landlord, and then you can receive your income gross, but you will have to make sure that you are completing a tax return. So since we have got income tax or corporation tax on rental income, and we have also now got capital gains tax on the disposal of property, I have to say that I feel that there are not really any huge incentives. And of course, stamp taxes will be liable if the property is within the UK. I have to see that I do struggle a little bit to see any planning advantages in holding property through an overseas company. But, you know, again, that's just something that we would, you know, there might be particular commercial reasons, but from a tax perspective, I can't see that there is really any incentive. So what I wanted to touch on today was situations where you are acquiring property and it's not perhaps quite straightforward in terms of knowing whether it is trading or investment, or indeed it might also be caught by anti-avoidance provisions, and there is legislation called the Transactions in Land legislation. So, you know, again, those issues may be important. For a company, to be honest, the rate of tax on income or capital is the same. There may be differences in terms of loss offset, but effectively it's the same. There is different allowability of expenses though, and the calculation of the tax due. So for example, you know, if you are borrowing money to renovate a property which you then sell, if that's a trading transaction, then you could claim a deduction for the interest. However, you know, you wouldn't get an interest deduction against a capital gains liability. It is much more important for individuals because, of course, there is a difference in the tax cost if it's income versus capital. In reality, not commercial property, but residential property, the biggest issue for individuals is not normally income versus capital. It's where somebody's actually claiming something like private residence relief on the disposal of a property. And the revenue are either trying to say, well, it's normal capital, or indeed that it is trading. But, you know, again, that is why the distinction is important. How do we know whether or not a property is, or the transaction is trading or capital? Well, we have to look at the intention when the property is purchased. So if you buy a property with the intention that you are going to sell it quite quickly, then it's trading. If you're buying it as an investment, then it's likely to be capital. Although your intention in relation to the property can change, in which case you would have to shift the property from capital to revenue, or vice versa. Now, effectively, when you're looking at intention, what you're looking at is what we call the badges of trade, and the revenue would be looking at things like board minutes, if you're a company, business plans, and so on, emails and other documents. The problem with people who regularly deal in property is often they don't necessarily have a particular intention when the property is purchased. I had a client a while ago. I got rid of him because in the end he just did my head in all the time. He was always buying property because he was well known in the industry. People would offer him property knowing that he would tend to have the liquid funds to buy it. And he basically bought the property and then decided what he was going to do with it. And that makes it very difficult to make arguments about whether something is trading or not. If we look at the badges of trading with reference to property, you can sort of look at a series of ideas. The badges of trade are in the left-hand column. So how long you own a property, do you do anything to enhance the value of it? You know, is there the possibility of getting income from property? How long have you financed it for? You know, what are the terms of the loan? And if you sell the property, what are the reasons for the sale? So if you own a property for a long time, you do very limited things to enhance the value. It's already quite profitable. You've got longer term financing, which means that you're probably not going to be selling it quickly. And in fact, you might have a loan where there are early repayment penalties. Any sale is opportunistic or market driven. There's probably very low possibility that that's going to be a trade. High risk would be where you hold an asset for a short period. It's initially got very low income and you redevelop it. You finish that redevelopment and then you sell it. So, you know, ultimately, those are going to be the kind of circumstances where those are the sort of things that you'll be looking at. Now, here's a couple of examples. When I've read through these examples, I'm going to ask them to put the first poll up so that you can have a look at this. So a fully let property is purchased in June 2022. The company says that it's a 5-year plus investment, but they then sell it a year later for a very large profit because effectively they were given an offer they couldn't refuse. Second asset is only 21% let when it is purchased. They undertake a scheme of refurbishment work with a view to selling it, possibly in the longer term rather than the short term. Occupancy has increased to 90% within 2 years, and so they decide to sell the asset. There's not a particularly buoyant market for that asset class, for that asset. So what I want to know is whether you think with asset 1 and asset 2, whether or not there is an argument to say that these are trading or investment. So perhaps we can have the first poll up so that we can see what that is. So both trading, both investment, asset 1 trading, asset 2 trading. Okay, so a good 50%, well, 50% if you think that both are investment, 12% both trading, and then there is a larger number of people just think that maybe asset 2 would be trading and not asset 1. Okay, thank you for that. That's quite interesting. And if we go on to the next slide, we can see that in terms of that table that we just put up, obviously the period of ownership is a little bit of a red flag. So the high risk, I'm sure you can understand my my colour coding. Red is high risk, orange or yellow is medium risk, and anything else is low risk. I think that for the first one, I think it would be very unlikely that the revenue would want to argue that that is trading, or would feel that they had a good argument, because clearly they had a longer term plan for the property, but it's sold early because there is a rising, they've got the opportunity to cash out easily. I think the second one is a little bit more marginal, and I think if the difference in the tax take was significant enough, I think there is potential that the revenue might want to argue that it's trading. If it was a company, there might not be very much difference in the amount of tax, and therefore, again, but it was bought with high vacancy. They've done significant initiatives to boost occupancy, and basically they've sold it when that's been completed. But whether or not you are trading, it is a matter of fact. And therefore you have got to consider whether or not there is a risk there. As I say, if the tax difference isn't great, then there's probably not a great deal of chance that the revenue are going to challenge it. If you move your assets from capital to stock, then effectively there are different tax treatments depending on the way that it goes. If it goes from capital to stock, so that if you have, for example, a commercial property that you decide that you've been using for the purposes of your business, but you cease trading and you decide that you're going to redevelop it, then it is transferred from capital to stock at market value. Any capital gain would crystallize, but you can hold over that gain. If it goes the other way, if you are appropriating from stock to capital, so say that you are a property developer, you have developed a property and then you can't sell it, then you would go across, it would go across at market value. It has to go across at open market value, and there is no way of mitigating it. If you have groups of companies where you are transferring an asset as a capital item in one to stock in another company, or the other way around, stock in one company to capital in another, you always transfer it between companies as fixed assets, and so you do the appropriation in whichever company you need to do it in order to achieve that. Okay, example here. We've got a property development company within a group. It's developed a property for a cost of £2.5 million. They've tried to sell it for £500,000 profit, for no success. The company has a December year end. They've got two options. Sorry, they've been approached by an unconnected company that wants to rent the property. The development company has no rental portfolio, but they think renting it out is the best idea. So they're thinking about transferring the property to a newly incorporated subsidiary. An alternative suggestion is to keep the property within the portfolio and simply lease it. So the question is really whether or not you have got whether you would be better retaining it within the current company, or whether you would be better off transferring it to another company, and what the tax implications are of that. In that situation, there are various possibilities. Now, if we look at that, transfer from stock to capital is going to happen at market value. So whether it is done in the first group, it's always going to be done in the company that's developed it, because it's got to be transferred into group whilst it is a capital asset. So the profit is always going to accumulate in the first company rather than the second company. Now, interesting, whether or not you could argue, if you don't transfer it, that it still remains in stock. Do you need to do that appropriation? Well, I think it will depend on whether or not what your longer term aims are. If you are renting it out, but then you are thinking that that increases its saleability and you are then going to sell it with the benefit of the lease attached to it, then you probably keep it within stock, and then you wouldn't have the dry tax charge that you are going to get if you appropriate it. It will depend to a certain extent on the accounting treatment. The other question that you have there is what is the sustainable market value? They've tried to sell it at £3 million, but it might well be that you can argue that the market value is less than that, although it is probably unlikely that the revenue are going to accept that there is no profit at all. So they're probably not going to accept you valuing it at 2.5 million. Couple of questions have come in. I will answer one of them now and I'll come back to the other one in a minute. If a property which is held in trading stock is transferred to a subsidiary as trading stock, not investment, does the property go across at market value or cost for tax purposes? Thank you for that. Actually, that's a useful question. Normally, when you've got a transfer of trading stock, it is going to go across at cost. Well, it will go across at market value, but you could elect for cost to apply for tax purposes. Now, the only slight problem with that is that it would normally only apply where you have got succession to the trading activities. Now, in that situation, it's probably not easy to consider a situation. It's probably unlikely that you're going to have a situation where you were transferring it as trading stock, where it wasn't going to be a succession to the trade. But that would be all you'd have to mention. Somebody has asked me what I mean by appropriation. Appropriation is where you have a change in status of an asset, so where it moves from being a capital asset to stock or stock to capital. In this context, that's what that would mean. Sorry, can I just ask that if you are going to ask questions, you could put them in the Q&A rather than in the chat. It's just that it saves me having to keep an eye on both of those. So yeah, that's what appropriation is meant by that. In this context, when we're talking about appropriation, HMRC may well consider what the accounting treatment is. And actually, sometimes we do get challenges from auditors on larger companies about categorization of property. HMRC will definitely look at accounting treatment, but it is only one piece of evidence, so it's not necessarily determinative. Before I go on and talk about transactions in land, let me just deal with the other couple of questions that have come in. Non-resident landlord in South Africa holds buy-to-let property in London. Do they need to file a UK tax return? They've been residing in South Africa for the last 15 years. Rental income is around 7k, which is below the personal allowance, and the client has no other income in the UK. You need to notify the revenue. Well, certainly what I would do in that situation would be notify the revenue and effectively ask them if they want a tax return to be submitted. If the revenue find out that, I mean, you have got a source of income in the UK, you should be notifying the non-resident landlords department. It's likely, I would think, if you notify them, that they will say, we don't want a tax return unless there is a tax charge. but it's something that you possibly do need to just pick up with them. Isn't there an IHT advantage for non-DOMs to hold commercial property through an overseas company? You are right that the changes to the inheritance tax provisions in 2017, meaning that if you have a residential property in the UK, it is included within your estate for UK tax purposes, does not extend to commercial property. I have to say that I think that there is and I know that we shouldn't do tax planning on the basis of what might happen in the future, but I think that there's a good chance that that will be extended to commercial property at some point. And so whilst I would bring it to clients' attentions as an advantage currently, and thank you for bringing that to my attention, I think that there is a risk in using overseas companies purely for IHT purposes. Okay, transactions in land. This is legislation that's been in place for donkey's years, but was amended in 2016, and it's basically targeted at situations. When it was amended in 2016, it was very much targeted at situations where non-UK resident companies were not paying tax on land transactions in the UK because of loopholes in double tax treaties. So I won't go into the details here, but it applies for disposals on or after the 5th of July 2016. And what the transaction in land provisions do is effectively treat your profits as if they are profits of a trade, where you are effectively getting value from transactions in relation to land which are not already subject to income tax or corporation tax. This can be in situations where a person or anyone associated with them is party to arrangements for developing property. Now, the conditions are that, and there are a number of conditions, the purpose or one of the main purposes of acquiring land is to realise a gain or profit from disposing of it. The main purpose or one of the main purposes of acquiring property deriving value from land, so that will be shares in a company, is to realise a profit from disposing of that land. You hold land as trading stock, or the main purpose of developing land is to make a profit from it. Now, as I said, this is targeted at situations where actually you would not otherwise be taxable in the UK. It does talk about income or corporation tax, and so theoretically gains, capital gains, could be converted into income using the transactions in land provisions, but HMRC basically say that they would still apply the badges of trade if you're disclosing something as a capital gain. They would look at whether they could convert that into trading by using the badges of trade. They wouldn't seek to apply the transaction in land provisions. It definitely doesn't apply where you are already taxed to income or corporation tax. Any gain arising before you have developed an intention to develop a property or in relation to private residences. The best way to look at this is to have a look at a couple of examples, and these come from the HMRC guidance. So here we have a non-resident property investor purchasing a property to rent it out. Clearly, nobody buys property thinking it's going to make a loss. And so there is also the benefit of getting some capital appreciation from this transaction. They hold the property for 7 years and then dispose of it. If you apply the badges of trading to this, you are not going to get trading. And so this is clearly a long-term scheme, and therefore you are not going to get caught by the transaction in land provisions. Second example, purchaser buys a property with the intention of developing it, then selling it. after developing the property for a period of time, they let it out for 6 months. But the purpose of acquiring the land was to make a profit from disposing of the land. Now, again, the likelihood is that the revenue would be able to make an argument under the badges of trade. But if they couldn't, then it would be caught by the transaction in land provisions. I probably ought to just explain why you don't get taxed for trading in the UK. You can only be taxed for trading in the UK if you are trading through a permanent establishment. And so some overseas companies developing the property in the UK were able to argue that they were not operating through a permanent establishment. And that meant that they weren't taxable on that income as trading profits. Well, now they would be caught by the transaction in land provisions. So finally, property investor acquires an old block of flats. They rent the flats out for a few years, then decide to redevelop it. There is a change of intention here. It is probably the case that the initial bit of it will be subject to capital gains, and then the bit after the intention would be included as income. From a very practical perspective, the one situation where probably from the perspective of the UK is where you have got overage type transactions, or what is sometimes called slice of the action transactions. So where you have somebody that has a piece of land, they're selling it, they get an upfront lump sum, but they are then going to get a proportion of any sale proceeds generated on the sale of that the developed property. In that situation, HMRC will often argue that the bit that they're getting, which is linked to the profitability of the transaction in the future, is going to be an income receipt rather than a capital receipt. And that often happens in relation to things like sale of farmland, commercial value, and so on. Somebody's asked the question, could that overage be valued as a shows in action? Well, it would be a shows in action because you are effectively have a right to receive something in the future. In terms of the valuation, if this, so the reference to a shows in action is probably in some ways actually more relevant if you've got a capital gain. So if you were looking at this transaction, you were selling a piece of land, you were getting an upfront amount, and then you were going to get an amount in the future based on a percentage of the development value, then what you would do if that was a capital gain is that you would have to estimate the amount that you were going to get in the future and include that up front as part of your capital gain, and then that would effectively get amended when you actually received the amount. If that overage part of it was caught as a under the transaction in land provisions, what you would effectively get is a capital gain arising at day one, and then you would get an income receipt when you received it in the future. So if you acknowledge that it is going to be a transaction in land, then you wouldn't actually have to value the shows in action, because you would simply be taxed when you received the amounts in the future on the actual amounts that you received. So it would only be where overage is effectively being taxed as part of the capital that you would have that issue. Okay, some good questions. Thank you. Right, I'm going to move on now and talk about capital gains. Now, the starting point might feel like quite straightforward, but there are some interesting points to bring up. So everybody is aware about how you calculate a capital gains liability, I'm sure. So you have your sales proceeds or market value if you are selling it on other than an arm's length basis. You deduct the acquisition costs of the asset, you can also deduct the enhancement costs, which are costs incurred in developing a property, which are still reflected in the nature of the asset at the date of disposal. I'll come on to that point in a minute. And you also get the costs of establishing, preserving, or defending title to an asset. I'll come back to that in a minute. And then we also have the allowable costs of acquisition or disposal. So I think there are a lot of questions asked on enhancement costs. As I say, it has to be reflected in the nature of the asset at the date of disposal. There's one quite interesting point though, and that is your original costs are not reduced if the asset changes. It's only your enhancement costs that are ignored if the asset changes. So what I mean by that is, let's just say you buy a property with a barn on it. I do have a lot of farming clients, so I'm often thinking about farming type situations. And you decide that what you are going to do is knock down that barn and build a structure which in which you're going to put offices, and you're going to rent those offices out. So you've got the cost of the original purchase, which would have included the cost of the barn. When you sell that asset, just because the barn no longer exists doesn't mean to say that you have to restrict the original cost, because that is what you paid to actually buy the asset. You would also then get the costs of building your new offices, and that would be deducted in calculating the capital gain. If you knock down the barn and built offices, and then for whatever reason you decided that you were going to knock down those offices and build houses, and then you sold those, then you'd get all of the original costs. You wouldn't get the cost of putting the office there because it no longer exists. But you would then again get the cost of building the houses. So it is important to understand what is there and what is not there. The other thing is that you can get a deduction for the costs of establishing, preserving, or defending title to an asset. There's also interaction with capital allowances, which I'm going to deal with later. Now, we're going to have a look at those allowable costs in a moment, but first, just to remember that there are situations where if you are selling an asset, you have to impose the market value. The first is where there is a bargain otherwise than at arm's length. Doesn't matter who the purchaser is, all HMRC you've got to do is show that it's not at arm's length. No other conditions. Now, it's very difficult for the revenue to argue that something is not at arm's length if there is no connection between the parties. So if I decide I'm going to sell my part of my back garden to my next door neighbour for £1, obviously there'd be no tax implications because it's part of my private residence, but just bear with me. So let's just say my back garden is worth £20,000 and I decided to sell it to my next door neighbour for £1. If there is no pressure on me, is that a bargain other than arm's length? Well, it probably is, but it's just quite a difficult one to know how the revenue would argue that. If I choose to sell it for £1 because that's what I want for it, it might be quite difficult for the revenue to argue that. But any situation where there is a significant discount on the value, then HMRC might actually make that argument. Not at arm's length is not the same as doing a bad deal or needing to sell at a reduced cost because of the speed at which you need to sell. We also then have the fact that where you have transactions between connected parties, you have to impose market value if the deal is done at a price other than market value. But again, there is a dispute about the market value as well. And there's also something called clogged losses if you have a connected party transaction. So if you sell to a connected party and you make a loss, then don't forget that that loss can only be used against a capital gain arising on a transaction with the same party. Allowable costs, again, don't forget that you get the incidental costs of acquisition and disposal, and you have got a list of what you can and can't claim. If you knock down the acquired asset in its entirety to build something else, does this preclude the cost of the asset in the future CGT computation because the original asset no longer exists? Really interesting question. But when we're talking about property, you will never completely destroy your original asset because you've always got the land. So the land and the building are a single asset. And that's a land law point. So even if you raise the building on that to the ground, you've still got the land. So you're never going to completely knock down an acquired or get rid of the original asset in that situation. If you had another type of asset, and my mind thinks about a car, though of course cars are exempt from capital gains tax. But if you had another type of asset, that might be the case, but certainly with land, that is never an issue. But another great question. Right, we're going to move on to our next poll now. This is a tax case. This was a farm owned by a lady. She died and it was inherited on her death by her son and a trust. The trust was basically for the other family members. The executor decided that actually that land should have been inherited solely by the son and not by the trust, and therefore transferred the interest in the land into the son's sole name. Now, the slight wrinkle here is that the person who made that decision in his capacity as executor was the son. So there was a little bit of perhaps, I don't know, he was a bit biased. The land was sold and the other members of the family challenged the decision made by the son to transfer the land into his name. Didn't go to the High Court. It was settled before it went to the High Court, but he made a payment to the other family members. And he claimed a deduction for the costs of the litigation in calculating the capital gains on the land, basically under the provision that this was part of the costs of establishing, preserving or defending his title to the asset. So I will ask the administrators to put up the next poll. What I want you to do is effectively, I know it says what arguments might be made. Do you think the legal costs are allowable? Yes, no, don't know. So if you could just indicate your answer to that question, that would be brilliant. I think this is a really interesting case. Okay. Ooh. Yes, say 39%, no 49%, don't know 12%. That's an interesting split actually, because I think most of the times that I've asked this of audiences, there has been a kind of a pretty much a split between the two. Now, this was a case involving, that's the name of the case on the slide if you wanted to have a look at it, went to the first tier tribunal and basically they said that this was not a cost which actually related to the land because the land had been sold. The family were not interested in having an interest in the land. They just wanted compensating for the financial loss that they had incurred. And so actually the first tier tribunal decided that this was not a cost of defending the title to the land. It is very interesting to know, or it's interesting to speculate what the decision might have been if the case had been taken to the courts before the land had been sold. So if the other family members had found out about this, in that case, I suspect he probably would have been able to claim a deduction for those costs. But obviously that is only speculation. Okay, so second case, company had borrowed money from the bank. Main shareholder sold the shares for £1.5 million, but under the sale agreement, the company was being sold free of debt. So she had to pay nearly £700,000 to the company to clear the bank loan. So her net proceeds were only £800,000. So the question I want to ask is the repaid loan allowable as a deduction in computing the chargeable gain? And so again, if we could have the next poll up, yes, no, don't know, that would be brilliant. And as an added incentive, once we've done this one, we're going to have a short break. So okay, again, fairly even split, slightly more no's, just over 50% said no, 42% said yes, a small number said don't know. Thank you for that. Again, an interesting question, I think. And again, the name of the company is shown on the slide there. Now, this is not an enhancement cost. The paying off the loan was not reflected in the state or nature of the shares at the time of the disposal. The value of the shares increased by virtue of the fact that the loan was written off, but it didn't alter the actual rights attaching to the shares in any way. It was not a cost which fell within one of the allowable costs, and it was not for defending the title to the asset. Now, of course, in reality, what they should have done is actually reduced the consideration in the contract and had the purchaser put the money into the company to discharge the loan, because then the sale proceeds would have been reduced and we would have had a different outcome. So it's another one of those cases where actually writing the contract slightly differently would have had a different outcome. Okay, it is 10 o'clock now, and so what we're going to do is have a short break. I think it's probably going to be 6 or 7 minutes, so I will come back around 7 minutes past 10. Hopefully that will give you time just to have a comfort break and make yourself a cup of tea if necessary. So I will be back shortly and we will continue with this session. If you do have any questions, obviously in the break, please pop them into the Q&A box. Right. Let's get started. Now, so capital gains for non-residents. Up until 2015, there was very little exposure to capital gains tax for non-residents unless they were actually trading within the UK, or indeed the temporary non-resident rules kicked in. So a charge was introduced in 2015 for residential property, but that was extended in 2019 to commercial property, as well as indirect holdings of both residential and commercial property. So if we focus on the commercial property aspect of this, as I say, this came within the scope of UK capital gains tax for any non-resident holding commercial property with effect from the 6th of April 2019. Now, the gain is calculated in exactly the same way, except that the original cost is replaced, if you want to do so, by the April 2019 value. So effectively, it is only the gain arising from the 6th of April 2019 onwards that becomes chargeable. You can have the you can elect to have the whole gain or loss taxed instead. I mean, clearly, if there is a loss on the property, you could see the advantage in doing that. It's not immediately obvious when there would be circumstances such that you would want the whole of a gain to come into charge, although I suppose potentially you could have a situation where there is something in a double tax treaty or within local law, which would mean that you'd want it taxed in the UK, but I've never come across a situation where that is the case. With residential property, you can work out the gain across the whole period and then time apportion it before or after 2015, but you can't do that for commercial property. For indirect disposals of UK property, which would also apply where you have got commercial property held in a company, then effectively, again, the gain comes into charge from the 6th of April 2019, and you rebase to that date. You are only caught if you are a property-rich company and you have a significant holding in that property company, and I'm going to talk about that in a moment. Now, the only complication that you might get in reality from a property in terms of the calculation of the gain, I think, is likely to be if you have had mixed use of the property. So perhaps it's been a commercial property that's been turned into flats, or it has been a residential property that has been turned into commercial use. Now, in particular, if that change of use occurred between 2015 and 2019, then you might have dual rebasing, and you might have different proportions of the gain coming into charge depending on the date of the change. Now, the easiest way to look at this is to have a look at an example. I've never dealt with one of these in practice, to be honest with you. And so I think these are fairly remote possibilities, but just for the avoidance of doubt. So someone's got a residential property, they buy it for £100,000 in 2013, it's worth £150,000 in 2015 when residential property comes into the non-resident capital gains tax charge. Converted to commercial use in 2018, worth £175,000 in 2019 and subsequently sold for £250,000. Now, as a purely commercial property, that would have been rebased to £175,000, so that it would only have been, there would only have been a gain of £75,000 when it was sold. But because it was partially residential before that date, then effectively what you've got to do is you've also got to rebase it at 2015. The gain up to 2015 is never going to be taxable. The gain between 2015 and 2019 is then prorated, and it was a residential property for 75% of that time. So 75% of the gain arising between 2015 and 2019 will come into charge, but not until the property is actually sold. So effectively, we've got a gain of 75,000 arising after 2019. We've got 25,000 arising between 15 and 19. We take 75% of that. So the total gain when that property is subsequently sold would be 93,750. But as I say, I've only ever covered this in theory. I've not ever had a question, I don't think, asked by any client about these particular issues. So indirect disposals, the legislation basically says that there is a gain arising when you have disposal of an entity which derives substantial value from UK immovable property. You can trace through a number of entities. If you had a holding company with a number of subsidiaries, you could trace through up to the shareholding in the holding company. But more than 75% of the value of what you hold has got to be derived from UK property. You are looking at gross assets, so you don't net off liabilities. And you are using the market value of the assets to determine whether or not the 75% test is met. So if you've got an overseas company that has got lots and lots of different types of investments, including some UK property, then as long as the overall value of the UK property is not more than 75% of the value, then you're not going to have an issue. But obviously, you do just need to be careful when you're looking at that. You don't take account of non-UK land. It's only UK land. So that's the first bit that you've got to think about. The second bit is that you've got to have at least a 25% investment in the entity during your period of ownership, although when we're looking at period of ownership, we would only go back 2 years at a maximum. Unless you have held that 25% investment for an insignificant proportion of time, and HMRC say that that is 10%. So that is, I suppose, to cover a situation, for example, where somebody sets up a company, they own the one subscriber share. So actually for a period of time, they actually have 100% of the company, but then shares are issued to someone else. So as long as in the end, that period where they hold that 100% of the shares is insignificant, then it won't be a problem. When we're looking at the 25%, we have a look at voting power, rights to income, rights to assets. You also have to take account of the rights of associates, although we do not take account of the rights of siblings. And obviously, don't forget that shareholdings can change such that this becomes a problem. Somebody asked me a question a couple of weeks ago where they had 5 individuals, or each of who had 20% of the shares in the company. And it was an overseas company, it was an overseas property company, and for various reasons, they were going to do a purchase of own shares such that 2 of the shareholders were going to have their shares repurchased. Now, we don't need to worry about the tax implications of the purchase of own shares because all of these individuals were non-resident anyway. But what we were going to do is we were going to end up with these 3 individuals having, having 33% of the shares in this company. So they were all non-resident as well. So they were going to go from a situation where actually they had no exposure to UK capital gains tax if they sold the shares in that company, because they wouldn't have had a 25% investment in the entity, to a situation where they would become liable to capital gains tax. And I mean, they'd held these shares for a lot of years. And the person asking me the question said, well, I assume that they would not become liable to capital gains tax until now, i.e. the point at which they get the 33%. And I said, well, no, because you look at this at the point of effectively of when they get it. Now, if they had, obviously they've got to have 25% investment during their period of ownership, but once we get past the 2-year point, they will then have that interest in the entity, and they will then be taxable back to 2019. So it's very clunky legislation in the way that it operates, and it is quite punitive. The other case I had recently, which was quite interesting, is to do with the application of a targeted anti-avoidance provision, which applies. So basically, it's talking about the fact that if there are any arrangements where the main purpose or one of the main purposes is to obtain a tax advantage, then the legislation is still treated as applying. And examples given by the revenue are where you manipulate the company assets so that the company is not property rich, where you you have order of transactions such that company ceases to be property rich, where you, well, basically there's a series of things where you are doing things specifically to make sure that this legislation doesn't apply. So let me give you an example. 4 brothers own 25% each of a property portfolio, which is worth a very large sum. We're talking tens of millions. Currently in a partnership, they're going to incorporate that partnership, hoping not to pay any tax on incorporation. One brother wants to become non-resident, and he wants basically to have 20% of the shares in that company rather than 25%, because he wants to gift the shares to his children once he's not resident, and he doesn't want to pay capital gains tax on it. Do you think that would be caught by the anti-avoidance provision? So I'm going to ask the administrators to put the poll up. Do you think that is caught by the targeted anti-avoidance provision? Okay. Yes, no, would need to know more about the motives. So yes, 54% of you said yes, 26% of you said would need to know more information about the motives. I think personally that this is a case where there is a huge risk that the revenue would want to attack this. And I'm partially motivated in that by knowing that this property portfolio is worth £80 million. So this chap's share of the capital gain, if it was 25% rather than 20, would be £20 million. So unless I think you can come up with a really good reason why he is only going to have 20% rather than 25%. And it might well be that if he's moving overseas, you could argue, well, he's going to have less of a role in running this business, and therefore it's been agreed by his brothers that he should have a lower share rather than a higher share. So there might be a commercial rationale behind it. But I think that it's exactly this kind of structuring that would be potentially risky or at risk of being attacked by the revenue under that targeted anti-avoidance provision. So I think you'd have to be quite careful. Question come in, where shareholdings differ from the agreed profit share between A and B, should the differences in the legal shareholding to the agreed profit share be documented as being in trust between A and B to align with the true beneficial interests? I think any situation where you are trying to argue that there is a difference from the apparent situation, so where there is beneficial ownership which does not follow legal ownership, I always think it is important at the very least to consider documentation. I don't see that there is any disadvantage in not documenting it, which isn't the same as saying you should document it. But I suppose I have had too many inquiries with the revenue where they have asked for a piece of paper which effectively doesn't exist, and therefore they have refused to accept that a particular situation is applicable. So I suppose that I am just, and I'm aware that the revenue are becoming more and more sceptical about a lot of things. So I can't see that there is any disadvantage in documenting it, really. So I would say the answer to your question is probably yes. Okay, one final thing I just want to talk about in relation to indirect disposals is that we've always, when we're talking about non-resident tax issues, we've always got to think about double tax treaties. Most of the double tax treaties that the UK have got with other people are based on what is called the OECD Model Treaty, the Office for Economic Cooperation and Development, who are an international organisation based in Switzerland who put out advice about international tax affairs. And so their model treaty covers, gives the UK taxing rights over direct disposals and indirect disposals. Now, not all double tax treaties follow the model treaty, and there are some double tax treaties which would actually mean that indirect disposals would not be taxable in the UK. And a good example of that is Luxembourg. The government are seeking to amend the relevant double tax treaty, but that hasn't yet been ratified by the Luxembourg government. So there is going to be a change in that at some point. So with some double tax treaties, it is quite important to understand which treaty that you're dealing with. Somebody's just popped in a question about whether or not recordings will be available. And the answer to that question is yes. There will be a link sent out to the recording for this next week. Obviously, if you are watching the recording, you will know that already. And I think that the administrators have just uploaded the slides into the chat box again for anybody who has joined since they were put in before. So I think that the material is now available for you. Okay, so let's go on and talk about capital allowances. Now, the situation with commercial property is very much different from the situation with residential property, because it is not possible to get capital allowances on assets put into dwelling houses, even if those dwellings are being rented out in some kind of commercial business. But you can get capital allowances on commercial property. So there's kind of two separate issues to talk about. The first one is probably not a particular fruitful area, but just to mention. Can't get capital allowances on the building itself. So, but parts of buildings you can get capital allowances on, and the main exception is going to be integral features or fixtures and fittings, which we're going to look at in a minute. Very, very occasionally, we do have the ability to claim capital allowances on a building itself, because that building has a function beyond just being the place in which you exercise the building, so it's the business. So it's not just a building. But that's a very difficult argument to make. So a good example we've got at the moment is a current case that's going through the courts for a nuclear fuel reprocessing plant. So this is a business that spent £1 billion on a place that will be able to reprocess nuclear fuel. Don't think I can explain it any more simply than that. And they are arguing that because of the nature of the product, and obviously they need to contain the radiation and so on, that the building itself is needs to be a particular type of material. It has to have very thick walls. has to have very detailed security. So they are basically saying that the building itself should get capital allowances because it has a function beyond being a building. At the moment, the courts are denying that. We have had some successes in the past. There was a case a few years ago on silo on a farm, where the kind of the structure that supports the silo machinery was found to qualify for capital allowances, but it is quite rare. It's not something that we see very often. You can, however, get capital allowances on, or potentially you can get capital allowances on the fixtures and fittings within a building, and we will look at those now. Yes, good comment put in the Q&A. With which, in which. So there is a distinction. You can get capital allowances on assets with which you trade, but not in which you trade. But I think even that, as a summary of it, doesn't really explain some of the nuances of the capital allowances provisions. But yes, it's a good rule of thumb. So when you buy a building, you very rarely will be buying a shell which has nothing in it other than walls and ceilings perhaps. You will also typically be buying the electrical systems, the heating systems, the aircon if it's got any, all of those kind of things. And so in 2008, legislation was introduced which allowed integral features, so those items that are fixtures and fittings within a building, to get capital allowances. It's special rate expenditure, special pool expenditure, so the writing down allowance is only 6% currently, but the expenditure does qualify for annual investment allowance. Now, effectively, we were looking a moment at what the definition is of integral features. The only other thing I would say we need to be a little bit careful about is repair expenditure on assets which fall to be treated as integral features. Normally, when you repair something, you get a revenue deduction for it. So, you know, if I've got a building and there is some kind of damage and I repair that damage, then I would get deduction through the P&L for those costs. If we have an item which falls within definition of integral plant, so let's just say a central heating system, and we repair that, the basic principle is that you would still get a deduction through the P&L, except if the cost of repairing it is more than 50% of the overall value of the asset, then you have to claim capital allowances on it in priority. Now, if you have got availability of annual investment allowance, that might not be too much of an issue, because you can claim 100% capital allowances anyway. But if you can't, you need to be aware of it. Okay, question. On the special rate pool at 6% and annual investment allowance of 100% on integral feature costs, are you saying you could make an election to use up the AIA and then the remaining expenditure falls into the special rate pool at 8%? I think you probably mean 6%. Yes, if you have got expenditure, you've got AIA, let's just say you've got £1 million worth of AIA and you incur expenditure on normal plant machinery or special rate pool expenditure, you can utilize your AIA in whichever way benefits you. So you can effectively use your AIA in priority against your special rate expenditure, rather than your capital allowances, your normal plant machinery. I don't know if that's what you meant, but that's what I am suggesting you mean. If you meant something different, then please do pop a message into the Q&A box. If there are repairs to an aircon system, but the aircon system within the whole building is substantial, would you look at the repairs on that particular asset, on that particular floor, or apply it to a small fraction of the total aircon system in the building? I hope that makes sense. Well, it depends on whether, as a matter of fact, it is a single system or it is separate systems. Now, I say that, but even as I'm saying it, I'm thinking it's probably going to be a single system, isn't it? Because I can't imagine in most buildings you would have separate aircon systems on each floor. But I suppose what you might have is that, for example, I can imagine that if you had a building that had an extension put on it, you might have a different system in the extension than you had in the main system. So I think you would look at the asset just on general principles. If it was a single aircon system for the whole building, then you would look at it on the whole building. If it was an individual asset for a particular floor, then you would look at it on an individual asset basis. So again, I hope that makes sense in terms of the answer to that. So yeah, if that doesn't make sense, then please come back to me. So what is integral plant? Specific definition: electrical systems including lighting systems, cold water systems, space or water heating systems, air cooling and purification, ventilation, floor or ceiling which forms part of those systems. So if you have an aircon system and going through a tube and one side of that tube is the ceiling, then that would form part of it as well. Lifts, escalators and moving walkways, as opposed to walking moveways, and external solar shading and active facades. So that's solar panels effectively. So there are still going to be situations where something might fall within the integral pool, but would also potentially attract normal capital allowances because it is normal plant machinery. So it has a use beyond just being part of the building. So specialised lighting would fall into that. As I say, for most smaller businesses and £1 million worth of annual investment allowance, that point may now well be less relevant. Okay, in general terms, when we're looking at commercial buildings, if you have a decent reference book on capital allowances, then most of those are going to contain a sort of a list of all of the potential assets that could qualify for capital allowances. And actually, as I say that, I wonder whether I can actually, what I will do in the next coffee break actually, because I think I've got a printed out list of capital allowances for commercial buildings that I used on one of my other courses. If I can find that in the coffee break, I will upload it into the chat. But most decent reference books will contain a list of the kind of assets within different types of buildings, so offices, factories and so on, that you are likely to be able to claim capital allowances on, and the type of capital allowances that you can claim. So that might be quite useful. I will see if I can find that in the coffee break that we will be having in about 20 minutes or so. Okay, so complications. When you buy a building, as I've already said, when you buy a building, you are also going to be buying all of the things that have become part of the building by virtue of property law. So the heating, the lighting and everything else. Now, if you are leasing that building, then there are rules as to whether or not you can claim capital allowances. Normally, the capital allowances will stay with the person who has incurred the cost and who also has either the freehold or the leasehold interest. So if you own a property as a landlord and you incur costs on which capital allowances can be eligible, then you would retain that even if you lease that land out, But if you are the tenant who incurs costs on the land once you have got the leasehold interest, then again you are going to be able to claim the capital allowances. If you had more than one tenant in a building and they jointly contributed to cost, then they would both be able to claim the proportion of the cost that they'd incurred. But what is the real complication with all of this is what happens when you sell a building to somebody on which there are in which there are fixtures. Now, this was legislation that was introduced in 2012 because HMRC thought that this particular piece of or this particular area was seeing abuse. Because what was excuse me, I've got hiccups. What was happening before 2012 was that somebody buys a building, they suddenly think, do you know what, part of what I paid must have been related to the fixtures. I'm going to claim capital allowances on it. And that might be after the event. That might be quite a long way after the event. And then you've got no way of going back and looking to see what had happened in the vendor's tax computation. So you could have a situation where effectively the person who sold you that building has sold those fixtures out as at £1 to get a balancing allowance on the capital expenditure, which means that your acquisition cost should then be limited to £1. But then you suddenly come along and think, do you know what, I'm going to put £100,000 on the fixtures, and therefore you've got abuse of the capital allowances provisions. And there were businesses going around and encouraging people to make these kind of retrospective claims. So in 2012, they changed the legislation so that the availability of capital allowances on a purchaser of fixtures is dependent on meeting two requirements, one called the pooling requirement and the second, the fixed value requirement. In some circumstances, which I will explain in a moment, the fixed value requirement is replaced by something called the disposal value statement. If you don't meet these requirements, then the purchaser does not get any capital allowances. Although it is important to note, and this is where this legislation really gets quite surreal, is that there are also circumstances where you can't meet these requirements, and therefore this legislation does not apply. So let's talk about the pooling requirement, and then we can go back to that point. The pooling requirement can only apply where the person selling the property was entitled to claim allowances. So if you are buying a building from somebody who has themselves incurred expenditure before 2008, 2008 being the date at which it became possible to claim capital allowances on integral features, then the previous owner would not have been able to claim capital allowances, and therefore this requirement could never be met. So if this requirement could never be met, then this legislation does not apply. And in that situation, you go back to the possibility of the purchaser simply being able to allocate expenditure out of their purchase price. But we'll come back to that point in a minute. If the past owner was entitled to claim allowances, then the purchaser can only claim capital allowances themselves if the vendor has effectively recognised the expenditure and then pooled it. Now, they can do that in the accounting period in which they sell the property. They don't have to have actually claimed any capital allowances on it, but they've just got to have made that allocation. The other alternative is that they've claimed first year allowances, so there's no residue of expenditure left anyway, but we know that they have claimed those capital allowances. If the previous owner couldn't claim capital allowances, as I've said, the condition is not met, this legislation doesn't apply. So, example, somebody buys a property in 2009 and they're now selling it to someone else. Because A bought that property after 2008, B is only going to be able to claim capital allowances on any expenditure if A Limited has identified that qualifying expenditure and pulled it. Now, A may be willing to do that. They may not be willing to do that. Let's just say that the sale is going to take place on the 1st of October 2022. A Limited has a 31st of March year end. They could pull that in the 31st of March 2023 year. Fixed value requirement applies where you have had your past owner who has brought a disposal value into account. So they have put something through a capital allowances computation in relation to the disposal. And then basically what has to happen is that the value has got to be agreed between the two parties. That's either done by signing a joint election under either Section 198 or Section 199 of the Capital Allowances Act. Section 198 effectively apportions the sale proceeds between capital allowances. Section 198 is freeholds. Section 199 is where you sell a leasehold interest. Exactly the same election, but just different type of property. If you can't agree between the vendor and the purchaser how much is going to be allocated to the capital items, then either party can refer it to the first tier tribunal to make a determination of the figure. Again, never seen it done the second way. I'm not aware of there being any cases going to the first tier tribunal on this particular point. So normally it is done by way of an election. So if we continue with the above example, A Limited had a central heating system installed in the company, which cost them, installed in the property, sorry, which cost them £30,000. They have to allocate, assuming that A pulls that amount, they have to allocate a value to that asset. Doesn't have to be market value. It can basically be anything between 0 and 30,000. It can't exceed the cost, because you can never have a disposal value which exceeds the cost. But what is actually put on it is going to be entirely down to the negotiation between the parties. Because obviously the lower the value you put on it, the more effectively the capital allowances that A Limited retains and B Limited can't get their hands on. So if they put £1 on that asset, then A would have retained all of the capital allowances and B gets no capital allowances at all. So it is an irrevocable election, and it is down to the negotiation between the parties. Now, it may well be that the person that you are buying the property of does not have to bring a disposal value into account, because actually they have no entitlement to capital allowances. And the most obvious example would be something like a charity or a pension fund who's holding the property but hasn't got any taxable income, so hasn't got any ability to claim capital allowances. In that situation, if there has been a previous owner, so not the immediate previous owner, but a previous owner who is basically signed a statement showing how much disposal value they have been using. And another example might be somebody ceases to trade and then sells a property down the line, or where you've got a charity, then effectively that purchaser can then get entitlement to capital allowances. As I've said, if the previous owner had no entitlement to capital allowances because they acquired the expenditure before April 2008, then the purchaser can simply apportion the sale price on a just and reasonable basis to give an amount on which capital allowances can be claimed. Biggest problem that we find, in all honesty, with the application of this legislation is the fact that people don't have good enough records. Let's just go through a couple of examples. Simon buys an office building in 2002, which is now selling. Not able to claim capital allowances on some of the expenditure as it's before 2008. Basically, when the person purchases that property, they will simply apportion the value of the building for any items that he couldn't claim capital allowances on. Somebody's asked a very useful question. In practice, would this work be done by a capital allowances expert? I think that it's one of those areas where I think in practice you would want, particularly if the figures involved were large, you'd want to get a capital allowances expert on board, really. And, you know, effectively, you're certainly going to be protected more if you've got a capital allowances expert involved. Couple of questions on the Section 198 elections. Where you have a subsequent sale where the seller's property was subject to a Section 198 election on purchase, is a further 198 election limited by the first election in the subsequent sale for the amount pooled? Yes, because effectively, if you've got seller, purchaser, second purchaser, that middle purchaser, their acquisition cost is whatever is in the Section 198 election on the first transaction. So when they sell in inverted commas, then their acquisition cost is going to be what is in the first Section 198 election. So the second election is also going to be limited. So you're absolutely right that this kind of has a real knock-on effect going forward. And someone else has asked, does Section 198 work in the same way, whether or not the parties are connected, related? And the question is correct. The only interesting point there is, and this happens on things like incorporation, you may be aware of the fact that if you have a connected party transaction, there is an election under Section 266 of the Capital Allowances Act, which you put in place to transfer the assets at tax written down value. So that would be where you have a connected party transaction and you put in place a Section 266 election to transfer at tax written down value. If you were transferring a property and you put in place a Section 266 election, you would also have to put in place a Section 198 election as well. And I have actually got a case working with the Revenue at the moment on that particular point, because obviously that's to do with integral plant only. If you're not transferring a business on incorporation or anything similar, then obviously Section 266 would only be talking about free plant machinery in it, and the Section 198 point wouldn't apply. But that's the only interaction between a situation where the parties are connected is that if you're using Section 266 to transfer assets at tax written down value, you'd still have to put in a Section 198 election as well. Right, carrying on with these examples, pension fund owns the freehold of a block of offices, have done since 2011, and they're now selling it. Because they are the only owner since 2012, there isn't a past owner who could have claimed capital allowances. So the pooling and the fixed value requirements are not relevant. And again, the purchaser can simply claim capital allowances on an apportionment basis. If it had been slightly different fact pattern and the pension fund had actually acquired the property in 2015 from someone else, then effectively the pension fund would only be able to pass capital allowances on to the ultimate purchaser if they had a fixed value statement from James, or a disposal value statement, sorry, from James. And I have to say, we don't see very many of those at all. And then finally, Care Home Limited sells a property it incurred 6 years ago. It hadn't been very good at identifying assets on which capital allowances had been claimed, but they agree that certain fixtures will be transferred at £40,000, and they sign a Section 198 election. 3 years later, the new owner realises that they could potentially have altered the situation, that they could have made a claim perhaps for some of the remaining fixtures in the property, but it's now too late. So once you get past that 2-year period, you cannot go back and get anything else. So, you know, it's one of those situations. And in reality, as I said, the biggest problem that we really see with the application of this legislation is getting the information. Obviously, sometimes the seller is going to be holding the property's trading stock if they are a developer. In that situation, again, the capital allowances provisions wouldn't be relevant. You would simply apportion the sale proceeds. But obviously, you need to get a lot of information. You need to get a commitment to sign a Section 198 election. And as I say, often there are real issues in terms of getting that information. Right, staying with the capital allowances, structures and buildings allowance, not necessarily something that we see very often. Structures and buildings allowance is available at a flat rate of 3%. It was 2% when it was first introduced. There is a 10% rate if you are a property situated within a freeport or enterprise zone, but we haven't seen many of those yet. It's available for new commercial buildings or conversions and renovations. It's only on the building bit of it, not the land. So if you buy a new commercial building, and you would obviously have to apportion the cost between the land and the structure itself. And it only applies for buildings acquired or conversions undertaken on or after the 29th of October 2018, which was the date of the autumn statement in that particular year. You make the claim when the building first comes into use. There are no balancing adjustments when the property is sold. You simply pass any unused allowances on to the purchaser. Anything that could be integral features within the building, you can claim annual investment allowance or writing down allowance on those. And anything qualifying for SBA will not qualify for annual investment allowance as an alternative. Don't see very much SBA, but I guess it will change as we go forward. So just to give you an example, a couple of examples exploring some of the issues. It's only you can't get SBA on dwellings. If you are constructing a building which is part dwellings, part commercial, then you have to apportion it. So a company incurs £2 million of expenditure on a development which is retail outlets on the ground floor and then student accommodation above. The student accommodation does not qualify, and that's quite an important point actually, because often student accommodation is seen sort of as with a slightly commercial tint rather than being residential property, but it does not qualify for SBAs. They decide that 1/6 of the cost relates to the qualifying, relates to the retail outlets. So the qualifying costs are 333,333, which means that very conveniently, the annual allowance at 3% of that would be £10,000. Excuse me. Now, Normally with capital allowances, and this applies for integral features, as with normal plant machinery, doesn't matter when you incur the expenditure, you still get a full year's worth of capital allowances. But with SBAs, you don't, you have to pro rata it. So here we've got a company that's got a 31st of December year end. Building is constructed for £1 million, but is not brought into account until the 1st of January, so 1st of April. So effectively, even though the annual allowances would be £30,000, in the first year, they can only get 75% of those. And obviously, HMRC might want evidence to demonstrate when a property has been brought into account. If this building was sold to another business at any point, there'd be no balancing adjustment. The purchaser would continue to claim the £30,000 per annum until all of the expenditure had been exhausted. And finally, there are specific provisions where you have got sale by developers. So for example, if you had a builder who bought land for 300 grand, built a property for 600 grand and then sells that for 1.2 million, then you would pro rata that 1.2 million. You'd effectively get 2/3 of that relating to the building. If that new trader doesn't use it and then actually sells it on, then again, the second person gets what the first person would have done. Could SBAs be claimed where the company incurring relevant expenditure only has a license to occupy? That is a very good question. I think the answer is no, because I think you've got to have a relevant interest, and I think that's got to be a freehold or a leasehold interest. I think you've got to have a proper leasehold interest. I don't think you'd be able to claim refurbishment costs in that case. I don't think you would be able to. I must admit, I'd probably have to have a look at the actual legislation. But I think you've got to have a formal leasehold interest, because you certainly do in other matters. Please don't apologise for asking a difficult question either. I like difficult questions. I just have to admit sometimes that I don't always know the answers. Final example. Oh, we've gone through that one, haven't we? The other thing to notice is that there's a slightly different interaction with the capital gains provisions. When you're calculating your capital gains tax liability, you make no adjustment for any fixtures within the value, either of the purchase cost or the sale cost. But with SBAs, you have got to effectively add back the SBAs that have been claimed when you calculate the gain. And that's because there's no balancing adjustment. So if we look at an example, someone constructs offices of £2 million, £500,000 of it relates to the fixtures, and SBAs are claimed on the 1.5 million. Now, obviously, there will be land involved in this as well, but I've carved that out of this example for simplification purposes. Businesses sell the office for £3 million. They allocate £1 to the fixtures. The gain appears to be £1 million, being 2 million take away 1 million. We make no adjustment for the fixtures, but actually what we've got to add back is the SBA claimed. So assuming that they've got 7 full years, then actually the total that has been claimed would be 315,000. So that would crystallise at the date of sale. And whilst we haven't seen very many of these cases so far, I suspect going forward that is going to be something that will get overlooked quite often. Right, that very conveniently takes us to the end of the section on leases. So we'll have another break now. It's 11:02, and effectively I'm going to come back just before 10 past. Oh, it's now 3 minutes past, so that gives us 7 minutes. So I'll come back about 10 past. And we've just had another message. Please, can someone have a recording? It will be allocated. It will be available. Sorry, what's the wording that they use? There will be a link to the recording put up next week on the K3 Hub website. So it will be available next week. And somebody's pushed me about the my sheet, and I'm going to look for it now. I have just posted into the chat box the summary of assets. It covers offices and retail properties, and so hopefully you can download that, and hopefully that will be useful to you. Well, thank you to the event staff for posting it. I inadvertently just posted to them and they reposted it. So hopefully that will be useful. I just think it's quite a good analysis. And we've also had another question in. Care home purchase pre-April 2008. So the pooling requirement is not met. Sellers have undertaken a capital allowances valuation pre-2012 and then claimed AIA on integral features. Would this mean the pooling requirement is met and a buyer cannot claim AIA on an apportionment of the price on a just and reasonable basis? What would happen if such a claim were made by the seller and the buyer was not made aware? That's a really interesting question. We've had some really good questions this morning, so thank you for that. I think what you seem to be suggesting is that they have claimed capital allowances on integral features where, sorry, the original sellers have claimed on integral features where actually they're not really entitled to do so. If you are meaning they've claimed AIA on features purchased after 2008, then clearly the pooling requirement is met. And what you'd have in that situation is your purchaser would be limited for the stuff that they have claimed AIA on, but they could do an apportionment for everything else if they could actually analyse those between the two different sections. If the sellers have actually incorrectly claimed capital allowances in respect of their integral features, that would then raise a very interesting question. And I mean, if the sellers don't make the buyer aware of that, then I think that the buyer would be entitled to claim AIA on an apportionment basis. But it's a really messy case. Hopefully I've answered that for you. But do feel free to post again if not. Right, so in this final 3/4 of an hour or so, we are going to talk about leases and then about stamp duty land tax or stamp taxes, mainly on leases as well. Okay, so leases are much more of an issue with commercial property than they are with residential property. And I have to say, I do answer a lot of questions on commercial property, I suppose mainly because a lot of my consultancy work is stamp taxes anyway. But I do have a lot of questions on commercial property. So you're going to have kind of two sides to it. You're going to have people renting out commercial property, but you're also going to have businesses occupying property for their purposes of the trade as well. So it's important to understand the provision. So just to make sure that we understand exactly what we're talking about, I'm sure everybody understands this. Two main interests in land, though, as we've heard, you can have a license to occupy land as well. Freehold and leasehold interests. Leasehold interest gives someone exclusive possession on a property, often for a specific period. You can have indeterminate leases, but those tend to be more to do with residential property, really, rather than commercial property, to be perfectly honest with you. And any leasehold, you can have successive leasehold interests. So as long as each subsequent leasehold interest is less period of time than the immediate reversionary interest, then you should be okay. Long lease is a lease of more than 50 years. A short lease is 50 years or less. And as I've said, you can have multiple leasehold interests. Grant of a lease is where you create a new interest out of an existing interest. An assignment of a lease is basically just where you sell an existing lease. So it's a bit like selling a freehold. One of the things that's quite important to acknowledge is that there is a difference in how the length of a lease is judged depending on different taxes. So for income and capital gains tax, if a lease is unlikely to continue beyond a particular date, then it's treated as ending on that date. So for example, if there is a break clause and it is likely that the break clause is going to be exercised, then you would treat the lease as continuing at that point. If the lease can equally, on the opposite side, if the lease can be extended, then you have to judge the chances that it will be extended. If it could be, if the tenant could become entitled to a further lease, again, you have to take account of whether that likelihood would happen. So with income tax and capital gains tax, you do have to make a little bit of a judgment as to how long you think the lease is going to be. For stamp taxes, and I know I'm only referring to SDLT there, but actually that it also would apply for LBTT and LCT. Break clauses or rights to renew are ignored, so you are only actually looking at the actual length of the lease in the lease itself. So assignment of a lease is, as I said, where the lease is sold to another party and that other party then continues to rent the property under the original terms. If it's a long lease, so more than 50 years, we calculate the gain just in the normal way, disposal value less cost. If it's a market rent lease, by which we mean that the rent being paid is market value and there is no premium, then there is no gain. Obviously, you've got to make sure that there is no possibility, if it's a connected party transaction, that the rent is less than market value. If it is a short lease, we have a capital disposal, but a lease of less than 50 years has to be wasted. There are what are called wasting tables in Schedule 8 of TCGA 1992. And basically, you have to remove from the allowable expenditure an amount relating to the intrinsic wasting and the value of the asset. And also any allowable expenditure would have to be wasted on similar terms as well. So if we take an example, lease taken out for premium of £50,000, 25 years to run, it's assigned when there are 13 years left to run with a premium of £40,000. So in the wasting tables, you take the percentage which relates to 25 years, which is 81.1%, and you take the percentage which relates to 13 years, being 56.167%. The question is, what is the taxable gain? I was going to ask you to try and calculate this, and then I just thought that might be a step too far. So the expenditure is 50,000, but we then have to exclude an amount calculated by the lease percentage when the lease was taken out, less the lease percentage when the lease is assigned, divided by the lease percentage when it is taken out. So it's 81.1 take away 56.167 divided by 81.1 times 50,000. So we are excluding 15,371. The base cost therefore becomes 34,628. Gain will be 55,371. What length lease will be termed a short lease? Sorry, I thought I'd said that already. 50 years or less. So 50 years or less is a short lease. Now, there is an added complication, because if you have a premium on the grant of a short lease, then some part of that premium is taxed as income. So in this situation, if the lessee, so the person who is taking on the lease, has claimed any tax relief for an income part of the original premium, then you have to remove that amount from the premium before you calculate the restriction. I'm going to look at an example in a moment of that. So there can be even more complicated situations. Sorry, the gain is 15,371. I do apologise. There's an error on that. Oh no, sorry. The gain is 5,371. But actually, that's still a mistake, isn't it? Because the base cost is 34,628. The premium for the grant of the lease is 40,000. So the gain is actually 5,372. So, but actually, is that maths right? Yeah, I think it's just, I've rounded. I think that should be 34,629 rather than 28. So that is the right gain, because the amount of premium for the grant of the lease, if we go back to the previous slide, is £40,000. So that is right. When anybody challenges anything I say, I always automatically assume it's wrong. It is sometimes, but anyway. So granting of a lease. So if you grant a lease to somebody and all they're going to do is pay you rent, then that's fine. Income is taxed on the landlord, may be deductible for the tenant if they've rented it for the purposes of their business. However, if it is a short lease and a premium is paid, then we may have a capital gains position. And in calculating the capital gains liability, assuming this is out of a freehold, then we would have a part disposal computation with the costs being allocated using the part disposal formula, which is A over A plus B, where A is the premium and B is the value of the reversionary interest. We are going to have a look at some examples of this. If the lease is a short lease, so 50 years or less, as I've said, though, there is this apportionment between capital and revenue. The amount of income is calculated by multiplying the premium by a formula which is 50 years minus Y, where Y is the number of years in the lease less 1. And so when you calculate the part disposal calculation, use an amended formula, little a over capital A plus B, where little a is the capital element of the premium, big A is the total premium, and B is the reversionary interest. There's also even more complicated rules if you're granting out of a short lease, but we'll come back to that in a minute. I will have a look at some examples, I think. Yeah, we are going to have a look at an example in a minute. Now, this is an issue that I think often gets overlooked. If you grant a lease to somebody with whom you are connected and you charge them less than the market rent, then HMRC can impute a premium, which is then subject to capital gains tax. If it's a short lease, there's no apportionment of that amount to income, but there still could be a capital gains tax liability. So let's, for example, say that I own a property and I have a limited company through which I trade. I grant a lease on my property to the company for £1. That is unlikely to be the market rent. So in that situation, HMRC can impute a premium. So it's basically what premium would an arm's length person have paid if they had rented that property. Now, one area where I really see this as being a problem and where I get asked an awful lot of questions and people often don't like the answer to that question is where you have got someone who's got a property portfolio. Now, I know this is an electron commercial property. I get asked the question most often about residential property where they want to transfer it into a limited company, but they can't do it because there's going to be capital gains or stamp duty land tax payable on the transfer to the property. So what they say is, well, I'm going to grant a lease in my property to this company for £1 and then have the company collect the rent from my arm's length tenants. In my view, it doesn't work. Now, it's only applicable if you've got a formal lease. And so I suppose you could grant a license to a limited company to enable them to do that. But I still don't think the revenue will be very happy with that. So let's have a look at 3 examples and see what the answer would be in each case. So first one is a 125-year lease granted for a premium of £400,000. Property was purchased for £450,000 and the value of the reversionary interest is £100,000. So it's a long lease, not a short lease. So we've just got a normal part disposal computation. The disposal proceeds of £400,000. The part disposal A over A plus B is going to be basically 400 over 500. So the cost that you can allocate against that premium is 400 over 500 times 450,000, which is 360,000, which means that you have a gain of 40,000 on that disposal. The only issue there would probably be getting a valuation of the reversionary interest. Right, the next one, 20-year lease is granted for a premium of £50,000. The base cost of the property was £100,000 and the reversionary interest is valued at 55. The first thing we have to do is ascertain the income value. So it's premium minus, the amount that is income is premium multiplied by 50 less the length of the lease minus 1 divided by 50. So the income element is 31,000, which means that the capital element is 19,000. So the revised A over A plus B formula is little a, which is the capital element, 19,000 divided by big A, total premium, plus the reversionary interest, multiplied by the original cost. So the cost in that situation is 18,095. The gain would be 31,904. Actually, I think that's wrong. Oh no, sorry. What you would do, the gain is 31,904. But then what you would actually do is you would deduct the income element of the premium, so that the actual gain would only be 904. I have to add that onto the slide actually, but yes, so the actual gain would only be 904 because you would actually deduct the income element of that. This case, we have got a 20-year lease granted to a connected party for a peppercorn rent. The arm's length premium would be 50,000, exactly the same factors as before. None of the imputed premium is apportioned to capital. costs would be calculated slightly differently, and so the gain would be 2,308 in that situation. Right. When we get a grant of a short lease from a short lease, you take the full premium, you deduct an apportioned cost based on the percentages, where S is the percentage when the head lease was, for the head lease when the sublease is granted. X is the percentage for the length of the lease remaining on the head lease when the sublease ends. And Y is the percentage when the head lease was originally granted. So I'm not going to go through an example because I've never come across this in practice. And after that, you deduct any amount that's been assessed as property income, but you can't create a capital loss. It just doesn't happen in practice. Or if it does happen in practice, nobody calculates the gains properly. I do think grant of a lease out of a freehold is something that we do see, and where there are potential issues. It might be in reality that it is only very large businesses that do actually take premiums or pay premiums. And maybe that's why in the smaller owner-managed business sector, we don't really see as much of this as we might. But I do think it is something that people don't necessarily deal with very well. I used to be an examiner for the Chartered Institute Taxation, and I used to write questions, and the training bodies always used to complain when we wrote questions on granting of leases, because they said nobody ever understands it. I mean, it was on the syllabus, but they were very, didn't like us writing questions because the answers were always appalling. One of the other areas where we see issues is where you get inducements paid to tenants. So where a landlord wants to get a tenant for whatever reason. You often see it in relation to anchor tenants in shopping centres. So somebody who owns a shopping centre might well be prepared to pay an inducement to, you know, someone like John Lewis or Selfridges or Marks and Spencer's to get them to agree to a lease, because then, you know, other tenants may well sign up. Now, if you are paying a cash amount to a tenant, that is what is called a reverse premium. And from a tax perspective, that is very inefficient, because your tenant will be taxed on that as income, either as a receipt of a trading business or a property business if they are going to sublet it. But unless you are a property developer, so if you are holding that property as a capital asset, you are not going to get a deduction for it as the landlord, because it is a capital enhancement cost. And so what you tend to see is landlords looking at things like contribution to fit out costs. Now, if the landlord assumes liabilities, so if, for example, you've already got a your tenant has already got business premises, and you say, well, we'll pay the rent on your existing lease, all of those things would be treated as reverse premiums, and all of those are going to be taxable. Now, what it doesn't catch is rent-free periods. Now, to a certain extent, if you are a tenant who's not paying any rent, then your taxable profits are going to be higher, because you're not going to be able to claim a deduction for the rent. Although from an accounting perspective, if you're a company, you spread the rent-free period over the life of the lease. And so you would still be getting some deduction. So often the most tax effective thing is to have a rent-free period. And so we do see those quite often. Now, assignments of lease, I think I've already covered that, so that slide is obviously in twice. Surrender of a lease is where somebody gives the asset back, or doesn't want to occupy the property any further. that is a disposal by the tenant and an acquisition by the landlord. If the landlord pays the tenant to actually vacate the premises, then that would be a disposal. Now, that payment might be enhancement expenditure on the part of the landlord, but if they re-let the property before they sell it, it wouldn't be, because it is not reflected in the nature of the asset at the date of sale. But most often the situation is that the landlord is going to effectively get rid of the tenant and then sell it with vacant possession. If a sum is paid by the tenant to secure surrender of the lease, that is a capital payment for the tenant and it's not an allowable deduction, and it would also be taxable on the landlord. Now, one way that sometimes we get around that is to try and structure those payments as dilapidation payments. So most leases require the tenant to keep the property maintained. So basically the premises is, sorry, excuse the pun, the idea is that you give the property back to the landlord in the same state as when it was given to you. And a lot of tenants don't do that. And so theoretically, the landlord could pursue them for the cost of that repair, those repair costs. But the argument goes that because those repair costs are typically going to be revenue in nature, if you make a payment to your landlord in lieu of those dilapidation costs, it is probably also going to be revenue. So rather than having a capital payment on surrender of the lease, what you get is a revenue payment which is deductible. The landlord would still be taxed on the receipt, but obviously if they then do the actual work on the property, then they're going to get a deduction for it and it's going to be tax neutral. So you will often see payments for surrender of leases to be structured as dilapidation payments. Obviously, it depends on how much the cost is likely to be and how much you're actually paying. So it's not always straightforward. Right, finally, I'm going to talk about stamp taxes. Obviously, when we're talking about land transaction taxes, there are three that we need to think about. SDLT, Land and Buildings Transaction Tax, and Land Transaction Tax. I quite often refer to SDLT because I just forget about the others, but I will point out where there are differences. If I don't say anything, then pretty much we are talking about the provisions being the same regardless of where you are in the UK. Now, in terms of current compliance issues, actually most of the current compliance is to do with the definition of residential property. And that is normally because people don't want property that they're buying to be residential property, because you then might have the 3% supplement for second homes, you might have the 2% supplement for non-residents, you might have the ATED linked SDLT rate if you're not going to have commercial use of the property. So most, as I say, of the compliance we're seeing at the moment is because people are trying to argue that property is residential, non-residential rather than non-residential, because stamp taxes across the board are payable on commercial property at a much reduced rate. Now, the definition of residential property is any property used or suitable for use as a dwelling, plus any land which forms the garden or grounds of such a property. Anything else is non-residential. Now, if you are buying something that is demonstrably commercial, so if you're buying a factory or an office block or piece of land, probably going to be commercial without any doubt. Obviously, issue arises with commercial property with a residential component, such as a farm. Now, a standard working farm where you have a farmhouse maybe a couple of rental properties, and then lots and lots of acreage, which is either being, farmed as arable, or where you are have animals on the land. That is always going to be mixed use, because there is a very significant non-residential component to it. So any property where there is current commercial usage or recent commercial usage, then you should have no problem in achieving commercial property rates for your stamp taxes. But there may be situations where issues arise, and effectively that should be, but again, it tends to be that tends to be the issue. That is just, I'm trying to think of a situation where there might be an issue. And I suppose if you've actually got somebody who is buying something commercially, it is going to be very unlikely that there will be an issue. But, again, you just have to think about it. So if you are buying a commercial property, then you are going to pay SDLT on basically on any chargeable consideration. And there are specific rules for determining what the chargeable consideration is, and in most cases it's going to be the price that you have actually paid. There are occasions when it is something different. So if you transfer to a connected company, it is the market value, and that's probably the biggest one. There are other issues, such as where there are exchanges of interest in land. And again, we do quite often have situations where people are looking at doing that, but more often with residential property, I think, than commercial property. So where you are selling a property, or you're buying a property, it's simply a case of identifying the chargeable consideration, paying the rate which is applicable to the actual type of property, and the compliance is that you have to complete that return within 14 days and pay over the tax, and hopefully it's going to be straightforward. With leases, there is a much more complicated situation in relation to stamp taxes, because the liability can arise in a number of situations: grants of leases, surrenders of leases, variations of leases, and there are particular issues where you have things like turnover leases. So where you have the grant of a lease, the rules are slightly different between the different stamp taxes. SDLT arises on what is called the net present value of the rent, which is a basic capitalisation exercise. There is a calculator on the Revenue's website. There is a mechanism for doing it manually. If you look at the Revenue's manuals, it talks you through the calculation of the net present value of the rent. Just use the calculator if you can, to be honest with you. If you are charging a premium, then the SDLT is payable at what is called the ad valorem rate, so the same rates that you would be paying if you had a freehold purchase. And so you basically add together those liabilities. So the net present value, you pay 1% in excess of the commercial nil rate band, and then 2% above 2 million. With turnover rents, we'll talk about those in a minute. Probably the other issue to think about is that with leases, it's not just where you take out a formal lease where there might be an SDLT liability, because there can be an SDLT liability where there is an agreement to lease, calculated on the same basis. As I've said, premiums, the ad valorem rate, so it's nil up to 150,000, 2% up to 250, and 5% above that. Reverse premiums don't attract SDLT. And again, if you have a connected party transaction where the rent payable is not market rent, then you have another adjustment by way of the premium. And so your SDLT liability would effectively follow that as well. For land and building transaction tax, which is Scotland, and land transaction tax, there are slightly different principles. Same rate of liability on the rent. Again, it's a net present value calculation. The only difference is that for the premium, there is no nil rate band if the rent is more than £1,000 per year. So effectively you pay, if we go back to the figures, you pay 2% up to 250,000, and 5% above that, there's no nil rate band. The compliance is slightly different as well, and I'll touch on that in a minute. For land transaction tax, effectively slightly different nil rate bands. 225,000 nil rate band, 1% up to 2 million, and 2% above that. And again, the premium, the rate premiums is slightly different. Again, there is no nil rate band, but in this case, there is no nil rate band on your premium if the rent is more than 13,500. So it is set at a much higher level. Now, turnover leases is where you are, as the name suggests, you don't know how much rent you are going to pay. Oh, actually, it's a useful question before I talk about turnover leases. Are goodwill or fixed fixtures treated as chargeable consideration? So basically, if you are paying for goodwill or fixtures, is that part of the chargeable consideration? The answer is no, if we're talking about goodwill. Yes, if we're talking about fixtures, because fixtures, fixed assets, the kind of the integral features that we've already talked about, are part of the property. Goodwill in the first instance is not treated as chargeable consideration, but there is an issue with goodwill. And the issue with goodwill is whether or not HMRC argue that the goodwill is what is called inherent goodwill. And that is a situation where HMRC's view is that the goodwill is not capable of being separated from the property. And so there's no separable goodwill, and therefore any goodwill which exists attaches to the property, effectively increases the value of the goodwill. Now, the types of businesses where we see the revenue making that argument are things like restaurants, pubs, hotels, nursing homes. I think the revenue also say casinos in there, but I've never dealt with a casino. Now, there has always been a big dispute between the sort of surveying world, the people who come up with the values of properties, and the revenue, as to whether or not that argument is valid. We had a case early last year, probably, where somebody granted a lease to a connected company, and there was a question as to, on nursing homes these were, and also separately transferred the goodwill into the company for separate consideration. And there was a question as to whether the goodwill formed part of the value of the lease, and the first tier tribunal, supported by the upper tribunal, agreed that it did. Now, I think that's, you know, one of few cases that the revenue have won, but certainly the question of goodwill is an interesting one, and obviously applies for both freehold sales and also leasehold transactions as well. Okay, so turnover, can I share the details of that case? That is a very good point. Let me just see if I can very quickly find that case. It may well be that I can't do it quickly. Okay, let me just see if I can search for it and see if I can get the oh. Yes, the name of the taxpayer is Denning, D-E-N-N-I-N-G. Yeah, Denning, and it was, oh, it's actually went all the way to the Court of Appeal. And the, yeah, so it's Denning, D-E-N-N-I-N-G. So hopefully that will enable you to find it. And I searched on that fairly easily, so that should help you. Okay, so turnover lease is, as the name suggests, where you don't know how much rent is going to be paid at day one because it's based on the turnover of the business. And just for example's sake, you know, franchises like McDonald's have turnover leases. So, you know, they are quite common in those kind of situations. So what you do with a turnover lease is you basically have to make an estimate of how much rent you think you are going to pay. And then at the end of 5 years, you revise your SDLT calculation, because basically when you're calculating the net present value, you only ever consider the rent in the first 5 years anyway. But after 5 years from an SDLT perspective, you then revise your net present value, recalculate your SDLT. If the lease is shorter than 5 years, then you would actually resubmit your SDLT return at the end of the lease and pay any additional tax, or indeed get a repayment of any additional tax that you've paid. The process is slightly different from a land and buildings transaction tax basis, because any lease that you have to file a return on a 3-year cycle. So you have to file a new return, taking account of any changes in the rent over the life of that. If your rent has only increased through RPI, you don't bring it into account looking forward, but you do looking back. And so the compliance for buildings in Scotland, much more onerous, and I suspect also not necessarily dealt with as well. With land transaction tax, same provisions as SDLT. You make an estimate initially, and then you have a supplementary return at 5 years. There is an additional anti-avoidance provision if your uncertainty ceases within 12 months of the 5-year point. Assignment of a lease is a normal sale, and SDLT, LBTT, LT2 and so on is just payable as normal. Assumption of the liability to pay the rent is not treated as chargeable consideration. That point is quite important because it would, under general principles, be treated as chargeable consideration. And anyone who takes over the lease also takes over responsibility for any additional returns that might become due. There are some situations where you assign a lease, it might be treated as a grant, and that would typically be where the grant of a lease, there's been no SDLT payable because it's covered by a relief. And if that's the case, if you then assign the lease for consideration, then you are going to pay SDLT at that point. And then there are various reliefs that may be available. If you have got a sale and lease back, if you have got transfers within groups, if you have got purchase by a charity. Now, one of the, on a growing lease, where holding over after a contractual term, but then renewed within 12 months, is there a rule that takes rent during the holding over into account with a new lease, even if a term in lease starts, e.g. 3 or 6 months later? Or must we pay years more rent if we hold over for any period? Okay, so if you have an existing lease which comes to the end of its contractual term and then is held over, which means that you remain in occupation, often whilst you are waiting for the new lease to be renewed, basically, as you have implied, at the date that the contract ends, the lease is treated as growing by 12 months. Now, so you pay SDLT on that additional 12 months. If you then start a new lease within 12 months, so say after 3 months, you will pay a new tranche of SDLT, but any overlap period you would get relief for. So effectively, there is a provision where there is more than one SDLT liability covering the same period. It's called overlap relief, and you would get relief for it in that purpose. So hopefully that answers your question. Variation of a lease can be problematic, mainly because for the tenant, an extension for a lease is treated as a surrender and regrant. Now, as I've said, and there are also other variations as well, which would create an SDLT charge, but surrender and regrant, whilst you would have overlap relief if you've already paid SDLT, it does create a chargeable transaction. And I have had a number of situations where we have got real problems with a surrender and regrant because of the way that the provisions operate. And I'm coming to the end of the session today. And so, you know, but if you have got an extension, you do need to be aware of the fact that there can be quite significant implications. Normally, if a lease expires just because it comes to the end of its lease, then no SDLT implications or other duty implications. If a landlord made a payment to a tenant to bring the lease to an end, that would be dutiable. A payment by a tenant to bring a lease to an end is not dutiable. Surrender and regrant is not an exchange of interest in land, and as we've already said, overlap relief may be available. Now, we did have one question come in before this session, so I just thought I'd put it up on a slide. If a person buys a flat in a limited company and then transfers shares to a sibling or a child, is there stamp duty payable on the deemed transfer or disposal? The original shareholding, mother and son, have 50-50, now transferring to the son. Now, obviously, the limited company will have paid stamp duty, land tax, or other stamp taxes on the purchase of the property. There is no deeming provision, which means that shares in a property company are subject to stamp duty, land tax. If it is a gift, there would be no stamp duty payable, and therefore there would not be any stamp duty implications of that. Sorry, I didn't quite answer the previous question. I'm only concerned about how to tax the rent in the gap between leases. The original lease SDLT was only paid up to the contractual end term, and if the term of the new lease is not backdated, there's a gap. Sorry, I thought I'd answered that point. When you come to the end of the term of the lease, if you remain in occupation, then there is an extension automatically implied of 1 year. And so you calculate the SDLT on that extended period. So let's just say you've got a 5-year lease. You remain in occupation at the end of that 5-year lease, and then effectively it is renewed after 6 months. So there is a 6-month gap, but at the 5-year point, there is an SDLT liability arises on the original lease plus 12 months. So you would have to calculate the net present value at that stage on the basis of a 6-year lease. You would get credit for the SDLT that you paid for the first 5 years. So you're only going to pay on the additional 12 months. When the new lease is granted after 6 months, you will calculate the SDLT on that new lease, and then you will get relief again for the 6 months overlap. Hopefully that has answered the question now, and I do apologise for not having done that before. Okay, well look, we have only a few seconds up to 12 o'clock. I hope that you have found this useful. As Marie said at the beginning, please do get in touch with us if there are any topics you want us to cover or anything else. Okay, a few final questions coming in. In that stamp duty question, is the child being gifted shares as a minor? If so, the tax issues are much wider. Well, yes. I mean, sorry, I made the assumption that they were, if they were a minor, then they would not be able to have shares transferred to them because they can't hold shares anyway. So if it was a minor, you're absolutely right, there would be settlement issues anyway. If somebody will add their son to their property for remortgage, how will the SDLT work? If their son owns the property, then there is going to be, if somebody adds their son to the property, then their son is acquiring an interest in that property. And if they are effectively taking over half of the mortgage, then there will be chargeable consideration equal to the half of that mortgage, and therefore SDLT would be payable on that. Finally, somebody said, is it possible to have today's slides sent out to us? Slides have been added to the chat box a number of times. If for some reason you have not been able to access the slides through the chat box, I suggest you send us an email to the administrators, and they will send them out to you. Okay. And they've just been posted one final time into the chat box. Hopefully they can be downloaded. Well, thank you very much. Some really interesting questions. I would just say, as always, it's great to have interesting questions because it really adds some practical points to the course. And so thank you again for that. And so thank you. Have a lovely weekend, whatever you are planning to do. And I will see you again shortly, hopefully. Thank you.